In this video, we're shedding light on market conditions, such as what is a buyer's market versus a seller's market, what is a cold or a hot market, and beyond. By the end, you'll be an expert, and you can join us in making real estate investing easy. Speaking of which, I'm Veronica Weatherspoon, and it's time to make it easy. In real estate, the terms cold, warm, and hot are often used to describe market conditions, with cold referring to a recession or a contraction phase, warm referring to a stabilization or a peak phase, and hot referring to an expansion phase. These terms are used to convey how active the market is, with a hot market indicating a high level of activity and a cold market indicating a low level of activity. Similarly, the terms buyer's market and seller's market are often used to describe market conditions. A buyer's market refers to a market where there's an abundance of homes for sale, but relatively few buyers, making it more favorable for buyers because they'll have more negotiating power and can often find a good deal. In contrast, a seller's market refers to a market where there's a shortage of homes for sale and many buyers, which makes it a more favorable market for sellers as they have more negotiating power and can often get a higher price for their home. An expansion phase or a hot market is often referred to as a seller's market, and there's high demand and low supply, meaning that the houses are selling quickly and at a high price. In contrast, a contraction phase or a cold market is often referred to as a buyer's market, and there is low demand and high supply, meaning that the houses are selling at a relatively lower price. It's important to note that these terms are generalizations and market conditions can vary, even within a specific area and time frame. Factors such as location, property type, and price range can also affect market conditions. Additionally, these generalizations may not always hold true, as real estate markets can be affected by a variety of external factors and are subject to change over time. So we've hinted towards the technical terms, but let's talk market science. There are four main types of real estate market cycles: expansion, peak, contraction, and recession. Let's talk expansion. During the expansion phase, the market is characterized by increasing home sales and prices, low unemployment, and a strong economy. This is typically a good time for sellers as demand is high and prices are rising. An example of a location that recently experienced an expansion phase is Seattle, which saw a significant increase in home prices and in sales from 2015 to 2018. The peak phase marks the top of the market and is characterized by a decrease in home sales, stabilization of prices, and possibly a slight increase in unemployment. This phase is often referred to as the cooling off period, as the market is starting to slow down. An example of a location that recently peaked is San Francisco, where home prices reached their highest point in 2017 before starting to decline. The contraction phase is characterized by a decrease in home sales and prices, an increase in unemployment, and a struggling economy. This is typically a buyer's market as there is a surplus of homes for sale, but there's less demand. An example of a location that experienced a contraction phase is Las Vegas, which saw a decline in home sales and prices during the 2008 financial crisis. A recession is the most severe phase of real estate market cycle and is characterized by a sharp decrease in home sales and prices, high unemployment, and a recession in the overall economy. This is a difficult market, as you can imagine, for both buyers and sellers, and there is little activity in the market. An example of a location that experienced a recession phase is Florida, which was affected by the housing market crash of 2008. It's important to note that real estate market cycles can differ from one location to another, and the duration of each phase can also vary. Do you feel smarter? You look smarter. But next time, I wouldn't show up in your underwear. Okay, obviously I can't see you. So rest assured you're good to watch this next video where we're making real estate investing easy.